Hey, I'm Jason, and this is Supply and Demand Daily. I'm going to go over what happened to that. No, that's not what I'm going to go over. I'm going to go over what we learned about the economy today. I'm going to tell you all about it. So I'm going to share some materials here, and here's what we have on tap. Consumer inflation expectations came out yesterday. I'm going to talk about why the Fin pundits think inflation has peaked, and then we have some interesting views on the housing market and housing prices. So let's dive right in. Consumer inflation expectations. In March of this year, when asked by the New York Fed, the New York Federal Reserve Bank, consumers believed that inflation exactly 1 year from March 2022, that's March 2023 if my math is right, would be 6.6%. Now, when asked the same question in April of this year, they said 6.3%. So that edged down a little bit. Maybe consumers are starting to get the idea that Fed policy maybe is going to rein in inflation, or maybe supply chain snags will alleviate, or whatever it is. But they may be starting to think that inflation is going to come down in the next year. We'll see how that goes. The small business index actually surprisingly unchanged in April, even though a lot of different kind of stuff happened in April. So several countries cut off exports of entire categories of goods, thinking of Indonesia cutting off the export of palm oil. Not that a whole lot of businesses in the U.S. necessarily use palm oil. It's just kind of a microcosm of the situation with foreign trade in general. But the small business index looking pretty positive at 93.2. Most values above, I believe it's above 50, are considered good and expansionary when it comes to this index. And this was actually a surprise to the upside. So when surveyed by the Wall Street Journal, economic forecasters in the financial industry expected that this number was going to move down a little bit to 92 point something, and it did not. So that's kind of good news there. We'll see how this develops over time. These are monthly metrics. The inflation report for April. So a couple things that I wanted to point out. One, deposit growth, that's the growth in bank deposits, the kind of bank accounts that we transact with every day, actually started to fall off in December of 2021 and January of this year. And then the reason that a lot of Fin pundits, that doesn't come from the Fin pundits, but the reason that a lot of the Fin pundits, that's financial people on TV, have been talking about the possibility that inflation has actually peaked is because of this divergence that we're going to look at between the core consumer price index, which does not include food and energy prices, and the broad consumer price index, which does include food and energy prices. So I'm going to show that right here, right now. The blue line is the broad consumer price index, so that includes the gasoline and the bread and the meat and all that good stuff. And then the yellow line is the core consumer price index, which does not include the gasoline and the bread and the meat and all that good stuff. So you can see that the two have followed each other pretty closely over a 5-year period. This chart begins in 2017 and actually just have split from each other in the last couple of months. So that's one indication showing that maybe all of the inflation that's left is due to production issues and logistics issues related to, foreign policy and COVID lockdowns in China. Again, this is not my view. This is the view of several people on TV and some members of the Federal Reserve Board. And then this yellow line, the core consumer price index, started to level off a little bit in the last couple of months. And so maybe we're on track for a downtrend in that metric. The rest of what's on the list, I'm going to go ahead and jump over to YouTube to cover it. So if you would like to hear that information, do tune in. You can follow the link in my bio. And if you're watching this on YouTube, just stay tuned for the next 15 to 20 seconds, and we'll be talking about everything else that was on that agenda. So with that, I hope you have a wonderful evening, and I'll talk to you later. Goodbye. Okay, welcome to the Supply and Demand Daily, the semi-deep dive. I'm going to start with bank deposits. Oh yeah, I'm not even, wasn't even sharing my full face, but whatever, that's fine. The charts are what's important anyway. There are all kinds of people who look like me, let's say, who would love to tell you about finance. So it's not exactly a unique signifier. Anyway, so deposits in the banking system, this level really grew quite a lot with the passage of the CARES Act, in where my mouse is pointing, in March and April of 2020. So we see this huge jump there with the CARES Act and the PPP loans, and which was the Paycheck Protection Program. These are policies that basically dumped a factor of, they dumped trillions of dollars into the economy with the one act that was passed by the Trump administration, the CARES Act. I think that was 1.8 to maybe $2 trillion that were dumped into the depository accounts of consumers, as well as the depository accounts of businesses with guaranteed loans and stuff like that. So we saw a huge surge in deposits there. We also saw one in early 2021 when the Biden administration passed I think it was a $1,200 relief check, if I remember correctly. And I actually don't even remember the name of that bill, so I'll have to Google that later. We saw a pretty big jump here as well, not as much as the CARES Act, of course, but we saw a pretty big jump there. And this is the monetary component of the inflation that we're seeing. So whenever you see rising prices systemically, Milton Friedman, the great economist of the mid 20th century, said that inflation is always and everywhere a monetary phenomenon. And if you just go through the reasoning and both logical and then look at the data, that really happens to be true. It's borne out over time, quite literally. You can't have broad-based consumer price increases without first seeing an increase in the money supply, and you don't really get them to last long either unless you see increases in the money supply. There are certain things that can throw something off, like the consumer price index, but if you're going to get real inflation, the kind that causes a lot of pain and maybe even forces some countries into a failure outright of their currency, such as the Weimar Republic in Germany, or more recently the country of Zimbabwe, I want to say 10 years ago, and countless other currency failures throughout history, especially in the last century. They all have a similar component in common, and that is that they are preceded by a huge increase in the supply of money, the amount of money that people use to transact and buy goods and services every day. So that's why it's important to look at these deposits, and I think a major aspect of the explanation for why we're seeing inflation rates right now like we haven't seen in 40 years is because we've seen ramp ups in this level of bank deposits, the spending money of everyday consumers and households. We saw a huge jump in that level over the last couple of years. It's been growing at a faster rate, and it saw these surges during when the stimulus bills were passed. Now, supply chains are definitely an aspect of that, of course, but if we're going to determine whether or not this inflation has legs, we have to see if the supply of money that people are actually using to keep buying the stuff, to keep putting demand pressure on all of these goods, is going up or going down, or if it's staying the same. Another thing to point out is that this number is not adjusted for inflation. So these are just raw dollars, and they're not going to be negatively adjusted by an increase in the inflation rate. So you can really look at this and see, okay, yeah, in December of 2021 and January of this year, we did see this level of deposits really start to wear off. And what kind of deposits are these? These are other deposits, the category of other deposits, which if you look through the Federal Reserve's measure of the supply of currency and supply of money, usable, transactable money in the banking system, this other deposit category really takes a huge chunk of it. That's a pretty big portion of the money supply. So it's pretty interesting there. Now, what the delay is going to be, if you notice, this huge surge in the money supply happened or at least in deposits, in bank deposits, happened in about March and April of 2020, and we got the inflation about 1 year later. So what exactly the lag time on seeing a drop off in these deposits or a leveling off in these deposits is going to be, between that and the inflation rate actually starting to go down is really unclear. I certainly hope it's not a year, because that means that we have until, that prices are going to keep going up at a pretty huge rate for about the next, 8 months, 7-8 months until December. But it certainly could be a lot less. One thing to keep in mind is that for the months immediately after that large ramp up in the amount of deposits in the system, there was a lot less demand in general, because you have to consider that unemployment was still pretty high and people were not going out to eat at restaurants and they weren't spending on services and all that kind of stuff. We really saw the inflation rate, the actual price increases, come as a result of the reopening of the economy when people started to spend more normally. All right, and I think that's all I had to say about that one. Now I'm going to move on to housing, because the last couple of days have been really interesting between what the Federal Reserve, or rather a couple of members of the Federal Reserve, or actually really just one member of the Federal Reserve Board, has said about housing versus what some, I'd say maybe representatives of the home building industry have said about housing lately. So I think it was last week that I reported on this blog on my Instagram and on YouTube that the rate of new home sales in the United States, this new home sales every month, which is reported by the Census Bureau, and that's on a 2-month lag, so we're talking about March of 2022 here. Well, in the last several months of reporting, I want to say about 6 months, the rate of new home sales in the U.S. has really started to level off. And why that's important is that in order to have sustained increases in home prices, or really in the price of anything, you have to have movement, you have to have velocity, you have to have a lot of transactions in order to keep that pressure up, to keep those prices going up. With housing, what we usually see is not a stagnation or a leveling off of home prices. What we see is that activity in the housing industry, that is the buying activity, kind of comes to a halt and it levels off, and then it goes down quite a lot. And then what happens in a matter of 6 to 12 months after that, or maybe even well, actually, in the data that I've looked at, it's more like 12 to 18 months, so 1 to 1.5 years. What happens after that is the prices start to follow. But the prices don't usually just stagnate. What happens to the prices is they go the same way as the activity in the housing industry. So not only will they stop increasing, they actually fall. And home builders have to be very cognizant of this. Especially after the great financial crisis of 2008, prior to which they had spent a great deal of time and money and capital and resources in terms of labor and machinery and all that stuff invested in expanding the production of new homes. There was a huge home building boom between 2002 and 2006 in the United States, leading up to the popping of the housing bubble in 2006 and 2007. And with that experience pretty recently in mind, the home building industry has to be very careful of how much they invest and how long they invest in expanding production in this industry. And so the home building industry started to grow a little bit prior to the pandemic, and then really took off during the pandemic with the demand for housing really getting ramped up. The Fed was buying mortgage bonds, which supplies liquidity directly to the housing market, unlike its purchases of U.S. Treasury securities. That's a little bit more detail than I have time to go into now. But basically, the gist of the story is that the home building industry has really had a good run over the last couple years, and in order to plan, they have to be very mindful of what demand is going to look like for housing, not only right now, but 6 months, a year down the road. So With that, one of the members of the Federal Reserve Board, that would be Christopher Waller, was interviewed at the Economic Club of Minnesota recently. I believe it was It was actually May 10th. It was Tuesday, May 10th, which is today. And there's not a whole lot of reporting on this in the typical news sites, but I caught it on the Bloomberg terminal. Just some quotations of his comments, and he was reported to have said a couple of small comments here. So the housing market is strong. He does not see anything bad happening to the housing market, and demand is strong and supply is short, which is to say, I believe, because I've sort of listened to this ongoing conversation on housing for the better part of a year and a half now, I believe that's probably in response to the idea of, are the ramp-ups in home prices that we're seeing due to excessive demand, or is it just because the materials required to actually start, construct, and finish a house are so expensive that supply is really lagging behind quite a bit? Now, to me, given all the data that has come out recently about new home sales and about existing home sales, that's simply the same figure, but for homes that were constructed prior to, it could be a 20-year-old home, it could be a 10-year-old home, 5 years, whatever. So just homes that are being sold for the second, third, fourth, whatever, 10th time maybe. But I found that reminiscent of something that Benjamin Bernanke, PhD, the head of the Federal Reserve, was talking about in 2007. And when I say 2007, I'm talking about May 2007, which was 3 months before the United States faced its biggest financial crisis in over 100 years prior. Or actually, not 100 years, about 80 years. So, in May of 2007, there was a lot of concern about the subprime mortgage industry. If you've seen The Big Short, you know all about that. And I believe it was a function very similar to the kind of thing the Economic Club of Minnesota was putting on, but a meeting of business leaders and economists. He said, given the fundamental factors in place that should support the demand for housing, we believe the effect of the troubles in the subprime sector on the broader housing market will likely be limited. And so what he's saying here is that even though subprime had been front page news for several months at that point, and the situation was just getting worse and worse and worse, what he's trying to say here is that those conditions were limited only to the subprime segment of the mortgage market. That is, loans made to high-risk borrowers, essentially, people with not very good credit scores, people with spotty employment history and not very high income, that kind of thing. When I say high income, I really don't mean high income, I mean consistent income. So we're talking about liar loans and all of those vestiges of the pre-Great Financial Crisis housing bubble. And so this is what he was saying in May of 2007. Now, again, 3 months later, most of the banks on Wall Street, most of the lenders on Wall Street, and even the money market mutual funds that supply a lot of the credit to financial companies didn't want to touch any of the mortgage market, not just the subprime segment, but any of it. The prime part of the mortgage market didn't want to touch it with a 10-foot pole. And 3 months before that, you had the chairman of the Federal Reserve, who most people credit with being the man at the helm, or the woman at the helm in Janet Yellen's case, at the helm of the economy, steering the monetary ship to make sure that everything is in place and so that the economy doesn't tank. And he was saying this. And so the reason that I compare these two things is that we have a situation where the evidence definitely indicates a significant slowdown. We know that housing market corrections happen, and they happen pretty deeply. There really are no soft landings, which would be where the average price of a home in the U.S. goes up to $400,000, and it just sort of stays there for a while. It doesn't go, or maybe it just increases a little bit after that. 400, $5,000, $400, $10,000, maybe over the course of several months or even a year. We don't see this in the 130-year history of housing market price data that we have. We just don't see that. It's not a phenomenon when you look at the long run, since we've had a developed housing market in the U.S. It's not a phenomenon that you see. And so it's important to look at the evidence in contrast to what these folks who have had this power over the economy bestowed on them. And then just to belabor that point a little bit more, as if I could beat it, dead horse analogies and all that. So who's the company here? John Burns Real Estate Consulting. One of their associates on Twitter posted a thread from their April survey of home building sentiment. And so these are just some of the comments that I highlighted. Dallas builder, interest lists are shrinking or buyers are truly pausing. Houston builder, many first-time buyers simply no longer qualify with the increase in interest rates as their debt-to-income ratio gets out of whack. Let's see what else we got. San Antonio builder, traffic has been cut in half since the hike in rates. That means the traffic is in home sales and applications for these new homes that the builders are building. Raleigh builder, investor activity has slowed dramatically. So investor activity would be people buying homes in order to rent them out to others. Provo builder, I think that's Providence. Investors are evaluating the investment more critically than in the past. Washington, D.C. builder, traffic is half of what it was in March, worried about first-time buyers. Many fewer real buyers than number of people collected on interest list last 6 months. So that means the conversion ratio of people who are interested in buying a home and then actually fill out the application and end up in the process to buy one is going, what would that be, up? Yeah, the ratio is going up. So there's a lot less people following through. Certainly more attempts from buyers to negotiate. So they're getting more piggy on prices. Seattle builder, paused by a large population of buyers to achieve our desired sales pace. We had to make price adjustments, rates starting to knock people out of qualification. Riverside San Bernardino builder, cancellations are starting to creep up due to loan declines and job losses. Job losses. That's something that's not in the that's actually something that's not even in the initial claims data that is published by the United States government. So it'll be interesting. That's San Bernardino, California. It'll be interesting to see if we start to see a more systemic rise in unemployment or job losses here in the near future. Waiting lists are certainly smaller. Saw an immediate change in buyer behavior when rates climbed over 5%. So it seems like that's a pretty big psychological level for a lot of potential home buyers. All right, Knoxville builder, detached 2,000 to 3,000 square feet. My house is less than 2,000 square feet. But anyway, square foot product still selling, just not with 3 buyers for every home like a few months ago. Allentown builder, double hit of higher home prices and higher mortgage interest rates clearly has reduced the number of qualified buyers. Our waiting list is almost zero as of April 30th. Allentown is in Pennsylvania. Philadelphia builder, between higher interest rates and higher sales prices, along with high gas prices and a volatile stock market, we're seeing a pullback in our sales. So the home building industry, which again has to be very future-minded because it has to make investment and planning decisions given what they expect the state of housing to be in the near-term future, 6, 8, maybe 12 months. This signal is telling you that the housing market is in for a significant slowdown, especially in relation to what it's been for the last couple of years. And again, the data says that slowing down in activity in housing doesn't lead to a leveling off of prices. It leads to an outright decline. So it's very interesting to see these perspectives of people who I would say are on the ground, or at least talking to people who are directly on the ground, who are interacting with the bits bits and pieces and moving parts of this industry every single day in comparison to people like Christopher Waller, who are appointed by politicians to talk about the economy and sit in a board meeting in Washington, D.C. and talk about what they expect is going to happen next based on ultra sophisticated economic models. So it's very interesting to see the difference in these perspectives, and time will tell who's right. I think it's going to be the home builders, but we will certainly see what happens. The next major data dump for the housing industry, I believe, is it could be later this week actually when the Case-Shiller index comes out, but whenever it's coming out, you will be able to find it here. I assure you of that. So I'm brushing up against 20 minutes here. I'm going to call it a day and wish you a good evening. I hope you've enjoyed this content. If you feel smarter than you did before you turned in and you think that other friends of yours would like to feel smarter, or members or loose acquaintances or people at work or whatever, do pass this link on. You can share my YouTube channel, you can share my Instagram, and if you have any feedback as to ways that I can improve the performance of these podcasts, well, vidcasts really, YouTube videos, to help you expand your I guess, actionable knowledge of finance and economics, please drop me you can send me a DM, or you can send me an email or anything like that, where you can just leave a nasty comment on my, on this video or anywhere else on my YouTube channel. I'll probably read it. And honestly, I kind of dream of getting some negative comments. So if you've got them, just fire them this way. I'm more than ready to answer some hate mail. So with that, anyway, yeah, I think I've covered all the bases. So yeah, take care. Thanks.